Hello, everyone. It's good to have you with us. And so we've been getting a couple of questions from friends and associates who are doing startups on the issue of funding. And the questions have arisen around whether um, f- what model of funding is best and ideal for startups in our current circumstance as people, and which route is better, whether it is debt financing or equity financing. So in today's video, we're going to be speaking on that matter, and we're going to be answering those questions. We have a couple of those questions that we're going to be doing our best to provide answers to. And so we're going right into it at this time. Debt financing is a situation where a startup gets funds from an investor, maybe not investor, maybe from a lending corporation, a lending agency, maybe a bank or a foreign financial institution, gets funds on a loan basis. So the money comes to the startup, they use the money, after a while, they pay back the money, they pay back the principal and the interest. So just like every loan, in debt financing, there's usually a principal and there's an interest. But it is important to say that for debt financing for startups, usually the rates are given at a very, very good, the lending rates are very, very competitive, so that the startup can use these monies to maximum effect. Okay, so debt financing is a kind of financing or funding where the money is given to the startup as a loan, and the lender to the startup does not have any stake, any controlling stake, or any sort of ownership stake in the startup. They give the money as a loan, and they get it after an agreed period of time. They get back their principal with an accumulated interest. That is debt financing. Thank you. So equity financing is a situation where the investor gives money to the startup with a view to have an ownership stake in the business. There's this conception, I don't want to use the word misconception, there's this conception that equity financing is strictly for tech startups. That's not necessarily the case. Tech startups can use a combination of both types of financing. A tech startup that is doing well can approach a commercial bank, a deposit money bank, for a loan, and it can be granted to them if the terms of the loan are favorable. They could access other kinds of funding, government intervention funds, such as, I remember there was the BOI SME fund and some other kinds of funds that are debt-based that startups can access. But most tech startups tend to use the equity financing model. But it doesn't mean that they are not examples of a combination of both models being at play for tech startups. So the question of a lot of money to raise for a startup and asking whether to go debt financing or equity financing is dependent on you, and it's dependent on perhaps the nature of the industry where your startup is located. So in answering that question, we also need to talk about the nature of the two kinds of funding. So in debt financing, an investor gives you money as a loan, usually with an interest, and you're going to pay back after a while. In equity financing, the investor gives you money as a part owner of your business, as a part owner of your startup. And so in debt financing, the investor is not interested in ownership. He only gives you a loan, and he expects the principal back with some interest. In equity financing, the investor is interested in a stake in the business. So it depends on the terms and the favorability of the terms. So if the interest rate on the loan, for instance, is very high, And on the other hand, you have an investor who is not asking you for a loan, who is willing to give you money to own a share of your business and is not significantly diluting your stake. And because whether we like it or not, every investor, whether venture capital or angel investor or whatever else kind of investor, will want to have a significant share of the business, because there's what is called FOMO, fear of missing out. So an investor can see through your business model, can see the growth trajectory of a business, and can tell that in a few years this business is going to be worth a whole lot of money. And so you find them making very huge demands on you. So equity financing, as good as it sounds, also makes you to lose significant ownership of the business. So you need to weigh your cards very well. You need to look at your cards very well and make sure that you're not setting up yourself to be bought out eventually, because we have had cases where eventually the venture capital guys, they buy out the founder, the co-founder, or whoever else, sometimes in not a very profitable manner. So you need to really, really check what you're doing and check the interests of the investor. If someone is willing to get equity in the business and is offering mentorship, business mentorship, and is giving you access to markets, and they are using their leverage to advance your business, then you might want to consider that. And they are not trying to be a shark, just to buy you out and take over the business. There's what is called forceful takeovers. They don't have the potential, or they don't seem like they will plan a forceful takeover in the future. Then equity financing might be your best bet. But if you don't have all of those advantages on the equity side, and someone is giving you a loan, a very, very low interest loan, and is not willing to dilute ownership, you're in full control of the business, he gives you the money, and the repayment terms are very friendly, then you might want to go debt financing. I hope that this answers your question. So the pros and cons of securing funds in foreign currency, it's really dangerous, I would say, because particularly in our context here in our country, currency has suffered significant devaluation over the last few years. So you want to be very careful in securing any kind of funding in foreign denominated currencies. Why? Because if the depreciation is significant, the devaluation rather, is very significant, what it means, for instance, if you have to pay an investor some money in dollars, we say $50,000, and at the time of the investment, the naira was exchanging for 1,005, and down the line, when you have run the cycle of the business and it's now time to pay some dividends to the investor, the naira is now exchanging for 1,008, for example. What it means is that you need 300 naira for every dollar you're supposed to pay. So you're going to need more nairas to be able to meet up with that obligation, and that can be a burden. On the other hand, if the naira gains against the dollar, it becomes advantageous. So you need to weigh those things very, very critically, very, very carefully. You need to, and of course, what that will do for you is that you have to pay close attention to the MPR of the CBN, and to make sure that you are in touch with the macroeconomic direction of the economy, to make sure that you're not shooting yourself in the leg. I believe that answers your question. So weigh it very well. I will not advise at this time that you get funding in foreign denominated currency, except you really have a business model or a business that the returns overcompensates for the devaluation or the depreciation of your local currency. If your business model is, if the business, your line of business is so profitable, you do over 1,000% in profit or 500% in profits, then it overcompensates for the devaluation. But where you don't have that kind of business and that kind of rewards from that business, it's very risky to get foreign denominated funds. I think that has answered that question. So you have so many stakeholders in your business and you want to have sole ownership. That's a tall order. That's a really, really tall order. Why? Because you need to buy them out and you need lots of money to do that. So the simple thing I would say is, if you want to have sole ownership, then you need to be able to generate a lot of money to be able to buy them out. So if you have a lot of stakeholders, I think your easier route would be to maybe reduce the number of stakeholders to a very manageable size, first of all. So let's say you have about 7 or 10 investors at the time. So find a way to limit the number to maybe 4 or 5 investors, a more manageable size. Okay. If you reduce the numbers to that, you might find that the reason you wanted sole ownership was because of some of the ones that you have been able to get rid of. Okay. And then you might no longer have the need. But if after you have gotten rid of some of the stakeholders, you still feel the need to have sole ownership, then of course you have to put in the work and you have to keep making money, or you have to find a way, maybe get a bank loan or get some foreign direct investment. But again, that still comes with, you'll still have to grapple with some serious financing challenge. Of course, depending on the size of a business, if it's a very successful company, that means you need tons of money to be able to buy out everyone. But if it's not a very big business at the time, then you don't need a lot of money. So all you need to do is walk around making sure you're able to buy out everyone, meet their demands. Of course, some people will not want to sell at a very cheap price. Some of them will give a very, very, very difficult price so that they can get maximum rewards for you buying them out of their stake in the business. So it's doable, but you need a lot of funding, you need a lot of strategy to get that done. Thank you. So in case you have other questions that we may not have answered in the course of this video, maybe you're a first-time founder, a co-founder, you've been in the startup ecosystem for a while, and you still have more questions around financing, around funding for your startup, and we haven't yet answered any of the questions you have in mind, please feel free to drop your questions in the comment section. We'll be glad to respond to them very quickly and very promptly. And so it's been a pleasure having you around for this conversation. Thank you for watching this video. Please, in case you have not yet subscribed to our channel, we'll be glad to have you do so. Share this video, like it, and drop your questions, drop your comments in the comment section. And so until next time, keep faith alive and keep pursuing those dreams. See you at the top. Have a good time.